Hello and welcome to SRIRAM's IES. In this video, we will be discussing the next part of our chapter Fiscal Policy. We are discussing the Indian Economy book by SRIRAM sir himself. In this book, we have already covered 7 chapters and this will be the last chapter for chapter 8. This will be the last video for chapter 8 and in this video, we will be discussing one important concept of economic stimulus. Understood? Or we usually call it fiscal stimulus. Simple. Now, we have already discussed it multiple times that why government needs to stimulate economy. Why? The question itself can be answered because whenever it was answered by Adam Smith himself. Adam Smith, the most, I would say, protagonist of having free market economy, also mentions this thing that it shouldn't be always that we should leave the producers and consumers in a free market economy. Rather, these producers and consumers who are otherwise rationally thinking and rationally economic men, or I would say rational economic men, they are acting with the forces of profit and utility. Simple. However, when we talk about this, he also says that there are invisible social benefits which will be there in the market. But Adam Smith himself says that government has a role. He says government has a role, although that role should be minimal. It should not be confused with this thing that classical economists say that there should be no role to the government. That is not the actual reality. Rather, we should understand that minimal role to the state. When? When should state act in the economy? They should act whenever market fails. Whenever there is market failure. We also discussed lately about that whenever we need to stimulate economy. Whenever we discuss fiscal policy, we also understand that fiscal policy is cyclicist and counter-cyclicist fiscal policies are there. Now, these fiscal policies are used in order to keep the economy in a balance. Cyclicist and counter-cyclicist these fiscal policies are there to balance the economy and to bring back economy from recession or to tape the economy whenever there is overheating of economy. So therefore, whenever government puts in restrictions on the market or whenever government says per se uses the concepts of I would say minimum pricing or floor pricing or price ceiling, these all concepts are used in order to understand that or regulate the economy or regulate the market. Do you understand this? However, whenever we look at these policies, we should also remember one more thing that is very crucial, that whenever an economy goes into slump, whenever an economy goes into recession, whenever an economy sees a degrowth and negative growth rate, at that point of time, government must act swiftly. Otherwise, the market may, the recession which is otherwise of 2 quarters may lead to a depression and a prolonged depression. And somehow, it also may turn out into a double dip depression. So therefore, John Maynard Keynes talks about that why and how should we give stimulus to the economy and actually what stimulus does. Keynesian economy basically deals with the demand in the economy. That is their actual or is their appropriate demand in the economy. So whenever we talk about demand in Keynesian economy, John Maynard Keynes argues about that whenever there is no demand in the economy, what will happen? Whenever the demand in economy decreases. What does this mean? It means that people are not purchasing the goods from the market, which means there is now excess supply in the market. Whenever there is excess supply in the market, what will happen? Now the companies will start increasing their inventory. Why? Because they will stock their goods at their own warehouses. Now once they feel that inventory is too much, they will stop production Whenever production stops, whenever they start decreasing their production, it means what will happen? Now they do not need the excess labor, which is actually the concept of Gibbons, or I would say William Stanley Gibbons. He says that now the labors which were earlier required to derive the value of the commodity, now the labor requirement will also decrease, therefore there will be layoffs. Now whenever there are layoffs, it means the unemployment is increasing. Unemployment is increasing. Whenever the unemployment will increase, what will happen? People will have no money now. Therefore, this cycle will further continue. When they have no money, there will be no demand. Why? Because their consumption will also decrease. Do you understand? So this will be one such cycle. Another cycle, that when there is no demand in the market, therefore investment will also decrease. When investment decreases, it means there will be two effects of this. One effect will be that production will decrease. Say production as in, not this one. Production as in, we won't be able to create more capital goods. Say there will be no firms coming up. There will be no new entrepreneurs coming up in the market, because they will be having this apprehension that market is otherwise not working. Why should I start a factory? Why should I start investing into the market when market is not working at all? So that is one thing. Second most important thing, that when investment decreases, it means what? That people are not ready to take loans. When people are not ready to take loans, what will happen? Now banks will be having what? They might be having deposits of the people. Do you understand? People might be saving with the banks, because market is not performing, people are not investing into the market, so people will keep their savings with the bank. But bank is now doing what? Earlier they used, or they were in need of having that money of people. They were encouraging people to keep savings with the bank. But now banks will also understand that we do not need these savings. They are actually a burden on us. Even the employees in the bank itself are a burden on the bank now. So therefore understand it. Even the banks will start going for negative interest rates. Therefore, in order to stimulate demand, what do we need actually? Lately we discussed that one paragraph of John Maynard Keynes from the book The General Theory of Employment and Income. In this book, John Maynard Keynes mentions about one important thing, that whenever economy is in recession, whenever there is no demand in the market, what government can do is, it just simply fills the old waste bottles with cash, dumps them anywhere in the old used mines, and then fills them up or buries them under the waste of the, I would say, municipal waste or solid waste, fills them. And then lets the laissez-faire, let the private players go and compete for digging out that cash, bringing that cash in the economy, employing some people, giving them that cash, that whatever cash you derive out of this, whatever cash you mine out of this, you take some of it, and some of it will be taken by the company itself, and then this too will help us to stimulate the economy. That is what Keynesian thought process is about, that we need to stimulate the demand. So in order to stimulate the demand, what we will do is, we will increase the money supply, because over here if you see, the demand which decreased also had one more thing which was contemporary to this, that was there was low consumption. So whenever demand decreases, consumption also decreases. But if you want to increase the consumption, give them some ready-made cash. Some economists argue about this thing, that we can give helicopter money also. But is that the right strategy? That is a question which we will be discussing some other day. However, here we need to understand that if you give them some extra cash, they will start increasing their consumption, and whenever consumption increases, the demand will increase. When the demand increases, the companies will start producing more. When they start producing more, the cycle will start reversing. How? When they start producing more, they will require now more labor. They will employ people, they will get salaries. Those will encourage more consumptions. Do you understand? And when the employees, when the laborers receive their wages, they will also do what? They will increase their consumption and the cycle will go on. So therefore, the Keynesian solution is very simple. When the economic growth crashes or slows, the government must borrow and spend. Government must borrow the money from where? From outside and spend in the economy. To prevent further downturn as the corporate sector postpones investments. Why will corporate sector postpone investment? Because they know there is no demand in the market. So why will I produce the goods at the first hand? So fiscal stimulus is very simple, that higher deficit and higher spendings, that you borrow money and then spend money. Tax reliefs, that you talk to people, you give tax reliefs to people, you announce policies that there are huge tax rebates to corporate sector, to people, to income tax, we will rebate the tax. Or direct or indirect tax, both the taxes will be rebated. Say GST 2.0, FRBM limits will be set aside. Do you understand? The Fiscal Responsibility and Budget Management Act, the provisions of this act will be kept aside so that we are not now required, or we will just sideline the targets which are mentioned in FRBM Act. We will discuss FRBMA totally. Monetary stimulus, second most important point. Adam Smith also gave us the suggestion that whenever economy hits a low, whenever economy crashes, whenever the growth crashes, at that point of time, the first shield should be monetary policy and then the second shield should be fiscal stimulus. So therefore, interest rate cut, SLR cut, CRR cut. Now what will happen by this? Chalo, tell me, if the RBI bank decreases interest rates, what will happen? Repo rate is decreased. Whenever the repo rate will be decreased, therefore money supply will increase. Money supply in the market will increase. Second, SLR and CRR, whenever these two will be decreased, so these are known as legal reserve ratios. Whenever LRR will be decreased, what will happen? The money supply in the market will increase, because money supply equals to 1 by LRR. Understood? That is money multiplier. But money supply is something what? When you talk about money supply, LRR is what? Very simple. When we talk about CRR and SLR, what are these? These are legal reserve ratios which are kept by banks out of deposits. Say a bank got 100 rupees of deposit, they have to keep a 20 rupees of reserve and lend 80 rupees. Reserve in the form of SLR and CRR, statutory liquidity ratio and cash reserve ratio. Cash reserve ratio must be kept in the form of cash only. SLR can be kept in the form of gold, treasury bonds or government securities or cash. Second, one more important thing, that whenever government decreases this, so now earlier this was the condition A or situation 1, the situation B is that government decreased, RBI decreased the CRR and SLR, which means now the 100 rupee deposit, only 10 rupees has to be kept as reserves and 80 rupees will be, or 90 rupees will be given as a loan. Do you understand? This will increase the money supply in the market. Not only that, this will also decrease the interest rates which were earlier proposed by banks to lend money. Do you understand? That is why monetary policy and fiscal policy are the two solutions for this. Simple. Next, austerity measures. That government can also do one more thing. Whenever economy crashes, government can cut down on its spendings, government can improve the efficiency of its expenditure, government can eliminate the leakages, that is all and everywhere wherever there is a leakage in the economy, wherever there is money laundering happening, wherever there is corruption happening, wherever there is black money, we will try to bring all of that leakage. Whenever there is subsidy which is leaking, say we were giving too much of agriculture and fertilizer subsidies, we started giving DBT. We were giving too much of food subsidy, we started giving DBT. So that is how the leakages were prevented. Understood? Rationalization, that how to rationalize the expenses of government. First was direct benefit transfer, which we discussed. Second is Digital India, to promote digitization, to improve efficiency, reduce the paperwork, and to reduce the administrative cost. Paper cost will be reduced, administrative cost will be reduced, communication will be faster and easier through emails rather than writing letters. That is how austerity measures work. Healthcare efficiency, government is now promoting generic drugs which are easy and which are cheap, which are easily available, cheap and ready to use. However, earlier we were using what FDCs, which were highly costly, too much costly. If you go to any medicine store, ask them the difference between a generic medicine and an FDC, fixed drug combination, you will find out that there is huge difference between the prices. And that increase the out-of-pocket expenditure. Whenever out-of-pocket expenditure increases, it means you are left with less money. And when that happens, that you are left with less money, it means that you are getting day by day poorer. Understood? And out-of-pocket expenditure was one of the most important reasons, or I would say most crucial reasons, for one thing, that is for returning people from back to poverty during COVID-19. So that is one thing. Second, FRBM Act. This is the most crucial framework which we need to understand. That Fiscal Responsibility and Budget Management Act. Why to understand this? Say for example, whenever government has fiscal burdens, whenever government faces the fiscal burden. What do I mean by that? When government has very less money left, or whenever government is left with very less resources and government tries to borrow the money in order to fulfill its expenses, in order to fulfill its daily expenses, revenue, which we discussed recently, revenue expenditure and capital expenditure. Or sometimes if government has too much of, I would say, public debt, or government is taxing the people in order to generate more revenue. At that point of time, we should also understand that there are 2-3 things. Like if government borrows too much of money in order to ensure that its current government is running properly. Say government takes a loan today. Government takes a loan today in order to run the government for next 1 year. After 1 year, the government is over, we are done with the government and government has run, India is perfectly finely running for 1 year. But this loan was of 10,000 crores. We used these 10,000 crores to run India or to run the administration. Say salaries के लिए loan ले लिया गया. The loan was taken in order to pay the salaries of government employees for 1 year. Once this happens, what do you understand by this? The loan is 10,000 crore rupees. Have we paid it off? No. Here comes the problem. The problem is one simple. That is that this 10,000 crore rupees is now to be paid off, paid back for next 10 to 20 years along with the interest. So therefore, today's debt is a burden for future generation. This creates a situation of fiscal vulnerability. And whenever this happens, what will happen? That all our future growth is somehow vulnerable to the past debt which we created. Therefore, whenever we create a debt, that debt should be actually for what? For creating capital. That should be a debt creation, capital creation debt. Or debt create, I would say a debt taken to create capital, so that this capital will further generate benefits and we can pay off this debt. Or this debt should be self-servicing debt. This loan should be self-servicing. That I took a loan, I invested it somewhere, and now that investment will generate benefits for next 100 years, 1000 years. It will pay off the debt in next 10 years and then the benefits will be all mine. That is how the fiscal prudence can be ensured. But what is currently happening, and we saw it lately, that this year also, government's revenue receipts and revenue expenditure has a vast gap of around 6 lakh crore rupees. That is a problem. So therefore, FRBM Act 2003 establishes some of the limitations on the government. That government can do this much of borrowings and government can do this much of expenditure and do not need to exceed the borrowings, ensure fiscal prudence. So therefore, this act is for What? Fiscal discipline of India. Understood? Borrowing limit, government cannot borrow beyond rational thresholds. Beyond a rational threshold, government should not borrow. Say for example, if I talk about it right now, FRBM Act keeps the target at 50 plus 1. But if you see current debt to GDP ratio, it is around 80% of India. Lately there was a study done by some economists and they concluded that the debt to GDP ratio, if it grows more than 90%, then it may slow down the growth. It may slow down the growth of the economy. However, that is something which the research has been questioned, criticized by other economists also, so I never discussed that research. So, one more thing, zero revenue deficit, the borrowings for consumption must be brought to zero. Borrowing for consumption was this only, that if you are borrowing to consume it within the year, this should be zero as per the act. Asset creation, borrowing should be only for creating assets and there should be a debt ceiling on the government which is 60% overall debt, 60% of the GDP only. RBI should be given independence in terms of monetary management. Now let's discuss about FRBM Act. The main objectives of FRBM Act are first to ensure fiscal discipline, second to ensure there is long-term economic macroeconomic stability, intergovernmental, intergenerational equity of debt should be maintained, that we should not create burden on future generations, sustainable public debt, that whatever borrowings you do, they should be sustainable in itself. As I said, it should be self-financing debt. Transparency in the government finances and better coordination between fiscal and monetary policy. These are the objectives of FRBM Act. Why was it introduced? Because there was rising fiscal deficit of the government, increasing public debt and excessive government borrowings, macroeconomic instability. We discussed that post COVID-19 fiscal deficit reached 9.5%. That was the problem. However, if we talk about FRBM Act, it should be around 3% only. So therefore, FRBM Act mentions the first thing, that government must pursue prudent fiscal management and maintain the sustainable debt levels. Second, government should also have certain specific targets. Remember this slide? Originally in fiscal, this FRBM 2003, the fiscal deficit was to be targeted at 3% of GDP. Fiscal deficit should be only 3% of GDP. What is currently? It is around 4.4%. Revenue deficit should be eliminated totally. We should not create revenue deficit at all. After 2018 amendment which was proposed by N.K. Singh committee, the debt becomes primary fiscal anchor. Central government's debt should be 40% of the GDP, while as combined center plus state debt should be just 60% of the GDP. Understood? There are mandatory fiscal policy statements. This question was asked by UPSC once, that what are the mandatory fiscal policy statements which should be represented, which should be presented to the parliament along with budget. That are these four. One is medium term fiscal policy statement, strategy statement, macroeconomic framework and medium term expenditure framework. Understood? Next, borrowing restrictions are there, should remain within prescribed limits. Framework discourages monetization of deficit. Earlier we discussed monetization of deficit already in the last video. Medium term fiscal framework should be ensured accountability by fiscal performance, debt, deficit trends, borrowing status and deviation from the targets. Government should ensure transparency in all of these. Government should allow people to know about what are the fiscal performances of government, what are the deficit trends of the government, how much deficit has been there and how much deficit is government targeting for the next year. Understood? Simple. Transparency should be brought in all of these, tax proposals, contingent liabilities, fiscal risks, assets. Along with this, there is one important clause, that is escape clause. We will discuss this at length. Role of FRBM review committee. Every 5 years FRBM should be reviewed and committee should suggest changes. And the first review committee was headed by N.K. Singh in 2017. That is which suggested these changes. Clear? One more thing. There is an escape clause which was suggested by N.K. Singh committee, that if there are certain external shocks. Do you remember the story of external shocks? Mobile phone was an external shock. Sending the goods out of the prisons of Germany and then selling them in outer market, in the open market outside the prison of Germany was an external shock. We discussed it lately. Now this again, whenever there is an external shock, a war, a tsunami, an earthquake, at that point of time, a pandemic, a natural calamity, at that point of time or national emergency, we can deviate a little bit from the FRBMA targets. Understood? That is why we had to deviate from fiscal deficit target and it reached 9.5% post COVID-19. Understood? Done? Now, FRBMA escape clause mentions about national security or war, natural calamities, severe agricultural distress, unforeseen structural reforms, sharp economic slowdown of more than 3 percentage points. At that point of time, we can deviate. Done? Next, FRBMA mandates some of the documents which we discussed already. Shifting to debt to GDP targets. Now, earlier we used to target only the deficits. Now we are targeting the entire debt. That how much it should be their debt to GDP ratio. The overall government debt, that is central plus state government debt, should be just 60%. And the target is 50% plus minus 1%. That is 51%, 50 to 51% should be the debt, or 49 to 51% should be the debt by 2031, that is the target. Simple. Next, states and FRBMA. States should also understand the responsibility of fiscal prudence. The revenue deficit has been eliminated, we discussed it already, because there should be no revenue deficit as per FRBMA Act. Fiscal deficit has been curbed, that it should be under 3%, this too discussed. Debt ratio has been decreased, debt to state GSDP ratio improved significantly in the past, and that is why there are multiple indices which rank, we discussed those indices in Niti Aayog itself, which rank states in terms of fiscal prudence also. Moving ahead to the next part of this chapter, that is fiscal consolidation. Under fiscal consolidation, we should understand that how government reached from 9.5% to just 4.4% in terms of consolidation of debt or fiscal consolidation. How did this happen? First, we brought in revenue reforms. Revenue reforms as in implemented GST, rationalized the tax rates, improved the tax collection efficiency through technology, faceless assessment. Capital receipts were brought in, or I would say capital receipts were increased by two things: disinvestment, privatization and asset monetization. Three things. Asset monetization means that we already have an asset, say for example I have a mobile phone, I can lend it to someone on rent, say 1000 rupees per month. Second, disinvestment, I can sell this mobile phone and use the money somewhere else. Privatization, I can increase the share of private players into my PSUs. Simple. Expenditure rationalization, better targeting of subsidies, direct benefit transfer and multiple other things with which our expenditure got improved. Clear? N.K. Singh Review Committee 2017 gave us some recommendations. These recommendations we already discussed. It mentioned that we should establish a fiscal council, an independent fiscal council which should look after the fiscal policy. Debt to GDP ratio should be 60% for overall debt, 3% should be fiscal deficit, flexibility should be based on economic growth. The current status is that economic slowdown and pandemic had induced uncertainty which currently has been tamed to some extent. Economic survey last year mentioned this thing, this economic survey which we have currently, which was presented on in February 2026. It mentioned that inflation has already been tamed, the growth rate is progressive, 6.5% growth rate has been suggested or projected. Further, we need to understand two things, crowding in and crowding out. These are two things which you need to understand. What is crowding in and crowding out? Just understand one simple thing. This is market. Our domestic market, our Indian market. Say for example, there are 100 people who save money. They save this money into 10 banks, or I would say financial institutions. Anyway, whatever money they are saving, just understand it. say the money is X amount, very simple, X amount. Now this money can be borrowed, it can be borrowed either by private players or by government. Simple. Government can also borrow, private players can also borrow. How will government borrow? Government will issue government securities and people will invest in government securities. Now understand, the interest rate, or I would say the discounted rate of these government securities is usually 4%. Thoda sa upar niche, just a slight. Private players, how will they borrow? They will issue some instruments, they will issue bonds, or they will issue commercial papers, they will issue commercial bills or any other instrument of money market, whatever it is. Say for example, for now we will just discuss about bonds or government securities. Simple. Government can also issue bonds. Municipal bonds are there, or government bonds, sovereign gold bonds, whatever bonds government can issue. Now both of the things, whether government security or bonds, both are debt instruments, both are the instruments to generate money from the market. Now let me understand, or let me tell you that if this amount of X is there and private players also want this, government players also want this, who will get it? The one who gives more interest rate? Both their borrowings depend on interest rate. If government provides more interest rate, see, understand this thing. Whenever there is a recession in the economy, whenever there is recession in the economy, do you now at this point of time, do you think that people will trust private players more or government more? Tell me. People will trust government more because market is not working. Private players are not working that much. The demand is already decreasing. The shares have already collapsed. Do you understand? So people will be more inclined to invest in government securities. So people will be more inclined towards investing in government securities. The larger share of X will go to government securities. This is crowding out. Very simple. And the converse of it, that when the market is otherwise playing very well, market is growing, people are more inclined towards private sector, that is crowding in. Now let's understand the concept, very simple. Crowding out means that when the economy is growing strongly and government borrows heavily, government borrows heavily, increased public borrowing will reduce the liquidity, pushes up interest rates, making the credit expensive for businesses. Therefore, private firms will reduce, limiting investments expansion despite overall growth. Now, I gave you the example of recession, that in recession this will happen. That is a natural cause. But even if the economy is growing at a stability, even if it is a normal year, economy is also growing. Still, the people have an inherent bias towards investing in government securities because they provide us more stability. They provide us more security, that we know that tomorrow government will not, they will not, I would say, shut their door on us. They will not deny the payment of treasury bonds. They will not deny the payment of government securities. So they will redeem those government securities. Once this is done, that whenever government increases their interest rate on government securities and borrow heavily, out of this market, now even if there is recession or there is no recession at all, still if government increases the government security, the interest rate on government security, it will get larger share. Once it gets larger share, that is crowding out. Simple? Understood? Now this crowding out has a problem. What is the problem? Problem is very simple. These private players will now find it difficult to generate a revenue. Therefore, even if they go to bank is not ready to give them loans. So therefore, they have to offer increased interest rate. And whenever they offer increased interest rate, whenever they say bank, okay, you are giving to government at 10%, I will give you 12%. Please give this money to me or please lend this money to me. It means that private sector, the firm is getting the money at a higher cost. Its cost of production is increasing. When the cost of production is increasing, it is definitely going to hit the market with inflation. Do you understand? Next is crowding in. Applies when the economy slows. When the economy slows or falls into recession. Government should borrow and spend more in infrastructure and public works. It creates additional demand in low interest rate economy. Low interest rate economy. It encourages the businesses to invest alongside the government projects, creating multiplier effect. Chalo. Now let's understand what it is. Very simple. I told you that whenever the recession hits, private sector is least likely to invest. Why? Because even I am not ready to purchase anything. There is a recession, market is not working, I will not purchase anything. Already demand is low, private sector will not produce anything. So therefore, private sector is less interested to invest in the market when there is recession. Very simple. Who should invest at this point of time? When there is no money in the market, when no one is ready to invest in the market, who should invest? Government comes in and invests. How will government come and invest? Government was earlier doing what? They were borrowing from the market. Now they will invest into the market. Why? And how? They will borrow from outside. They will do external commercial borrowings, they will do external borrowings, they will issue sovereign bonds and then bring in money into the market. Once they start infrastructure projects, say government started a project. Do you remember I told you the story that government should always keep projects ready and then whenever the recession hits, they should deploy one project. Now, what will happen when government starts a project? They will start, say for example, a highway. They will start constructing a bridge. That bridge will be tendered out. People will be ready to invest into it. Why? Because that is government money coming and flowing into market. So a private player sees, he sees the profit coming in. So therefore they will apply for the tenders, they will start investing. Along with this, they will already set the sentiment of market towards positivity. This means that government is crowding in the money. How? Because government leads the way for investment and private sector players will come in and crowd into the market and start investing. That is how the economy will start rolling. Understood? Very simple. Chalo. Multiplier effect. We discussed it here that it will create multiplier effect. We discussed it earlier also that post 2008 global financial crisis. 2008 global financial crisis. Obama administration was facing this burden. They were facing this question that how should we approach the economy now? At that point of time, US economy was having a multiplier effect of 1.6. It means if you invest 1 rupee into the market, it will convert into 1.6. It will generate this much of money. Now what is multiplier effect and how it is actually working? Very simple. We started with building an infrastructure project, say a port. This will generate private investment. Private players will come and start investing into it. Government just release the tenders. Private sector will bring in the money and start building the port. Once they start building the port, government will release the funds. Then once they release the funds, this private sector starts playing. They will create jobs. With this, employment will create. With this, wages will be created. Wages will be supplied in the market. They will start increasing the demand, consumption, and along with that, tax will also be collected. So this is an entire circle complete. Do you understand? That is how multiplier effect works. But the more faster and the more projects are there, the better the multiplier effect will be. Understood? Very simple. Off-budget borrowing or off-budget financing is one such concept which we need to understand. Very simple concept. Off-budget borrowing, see, for example, government does borrowing and mentions it in budget that, for example, we need to borrow. Do you remember that we discussed about fiscal deficit and borrowings? Fiscal deficit equals to borrowings. Borrowings are what? The money which government borrowed. Simple. Government borrowed the money. But there are some other institutions also, like public sector undertakings. Say Coal India is borrowing money from someone. Do you understand? If that money is being borrowed, that money which is being borrowed over there, that is not mentioned in the budget. It is off-budget financing, off-budget borrowing. So therefore, this was recently raised by CAG, Comptroller and Auditor General of India. He said that government is using this off-budget financing expenditures which are not reflected in the budget that obscure the true level of budgeting, borrowing. Government says that I borrowed only 100 rupees, but actual its PSUs have borrowed 1000 rupees. So the total borrowing was 1100 rupees, but we came to know about only 100 rupees, not the 1100. Because fertilizer companies used to borrow because they had arrears, they were not being paid the subsidy and all. Food subsidy was paid off through the National Small Savings Fund. The loans which were created through National Small Savings Fund, they were used to pay off the food subsidy. Infrastructure projects like NABARD, IFRC, PFC, they also started borrowing to invest and to finance these infrastructure projects. Now these are entities of the government, they are borrowing, it means government is borrowing actually, but that is not mentioned in the budget, that's a problem. Understood? Fiscal Council, what was the need of Fiscal Council which was recommended by NK Singh Committee 2017? They say that we need a sound fiscal policy which relies on accurate data and transparency. Therefore, we need an independent Fiscal Council. It will help us to improve accuracy, it will help us to promote adherence to fiscal rules and offer independent assessment. This was recommended by IMF also, this was recommended by NK Singh Committee also and DK Srivastava Committee also. Understood? An independent Fiscal Council, however, not yet created. Understood? Till now we have discussed all of it, and tomorrow we will be concluding with the budget reforms which were brought in recently, and this will be a 15 to 20 minute discussion about budget and budget reforms. Post that, after budget reforms, we will tomorrow start the next chapter also. Understood? With this, let's conclude today's discussion. I wish you all the best. Thank you for being here. Jai Hind.